Hello, my name is Patrick Verner, author of Trading on the Edge, and after 11 years inside the brokerage industry, I built this channel to help serious futures traders move beyond indicators and trade through structure, value, and risk-first execution. How to pass a prop firm evaluation using auction market theory. The institutional approach. Most prop firm traders fail not because their strategy is wrong, but because their psychology is right for a normal environment and catastrophic for an evaluation. Everyone thinks the evaluation is asking, can you make money? That is wrong. The evaluation is asking, can you make money without losing behavioral control under constraint? And that is a completely different test. Because the rules of an eval create a neurological pressure environment your brain has never encountered before. You are trading with a profit target above you, a drawdown limit beneath you, a clock in your head, and the constant knowledge that one emotional sequence can erase the entire attempt. So this video is about how auction market theory removes that pressure entirely. Not by making you fearless, not by giving you a magic setup, but by giving you something most traders never have during an evaluation. A structure that tells you when to trade, when not to trade, where you are wrong, and why the trade is valid before money is even involved. The evaluation psychology problem. Here is what most traders do not realize about prop firm evaluations. The evaluation does not test your strategy. It tests your behavior under constraint, and constraint exposes weakness. That one sentence explains why so many traders can trade well in replay, well in a personal account, and well on a normal demo account, and then completely fall apart the moment they start an evaluation. The strategy did not suddenly stop working. The trader changed, because now every tick has meaning. Every loss feels larger than it really is. Every missed trade feels like lost progress. Every green day creates the temptation to speed up, and every red day creates the temptation to make it back. That is the trap. The evaluation compresses time, pressure, and consequence into a single environment, and under that pressure, 3 failure modes show up time and again. The first is overconfidence after green days. I call this the day 8 phenomenon. A trader starts cautiously. They follow the rules. They respect risk. They take only obvious trades. Then they get a few green days, and instead of thinking my process is working, their brain starts thinking I have figured this out. That is a neurological overconfidence problem. The reward circuitry starts increasing risk tolerance because the recent outcome was positive. The trader sizes up, takes trades earlier, gives trades more room, and convinces themselves they are just being confident. But it is not confidence, it is brain chemistry. The second failure mode is revenge trading after the first drawdown. This is recency bias. One loss happens, and suddenly the trader stops seeing the auction and starts seeing the loss. They are no longer asking, is this a good trade? They are asking, can this trade get me back? This common shift in thinking is what destroys evaluations, because the moment the purpose of the trade becomes emotional repair, the trade is no longer structural, it is emotional. The third failure mode is forcing trades to keep up with the evaluation timeline. This is where psychological urgency overrides auction confirmation. The trader says, I only have a few days left, or I need to make progress today, or I cannot just sit here with no trade. And that is exactly when they enter the middle of the range, chase a breakout after the move is already extended, or short a low simply because the price looks too high. So make sure you watch until the end, because I'm going to give you a one-question framework that can stop almost every one of these prop firm evaluation mistakes before you ever click the button. Not after the loss is taken, but before you ever place the trade. The auction framework as evaluation structure. Now, here's the core thesis. The evaluation has one rule above all others. Protect the drawdown. The auction has one rule above all others. Only take trades where the structure confirms your entry. Those two rules are identical. The evaluation is testing whether you can follow auction logic. Most traders do not realize that it is what they are being tested on, because auction market theory is not just a way to read price. It is a behavioral filter as well. It removes the question, do I feel like trading? And replaces it with, has the market provided a reason to trade? That distinction is everything in a prop firm evaluation. There are 3 auction criteria that map directly onto evaluation survival. Criteria 1, structural location. You only trade at meaningful auction levels. Value area high, value area low, point of control, VWAP, prior session high, prior session low, opening range extremes, areas where business has previously been accepted, rejected, or negotiated. You do not trade in the middle of nowhere. You do not trade because price is moving. You do not trade because the candles look clean. You do not trade because you are bored. You trade because price has reached a location where auction behavior matters. This is why so many evaluation traders lose money in the middle of the range. The middle of the range is where conviction goes to. There is no edge in the middle unless you have a specific setup and a very specific reason. Most traders do not. They are just reacting to movement. On a chart, this looks simple. Imagine ES opens inside yesterday's value area. Price rotates between VAH and VAL. The inexperienced trader sees a green candle in the middle of value and buys it because it looks strong. The auction trader says, we're in balance. I need price at an extreme. And so they wait. Price pushes into VAH. Now the market is at a meaningful auction location. Now the question becomes, does price accept above value or does it reject back inside value? That is the difference between trading movement and trading structure. Criteria 2, auction confirmation. This is where most traders make the biggest mistake. They trade the break. Auction traders do not trade the break. They trade the acceptance or the rejection after the break. A level breaking is not enough. Price can break VAH and still fail. Price can break prior high and fail. Price can break VWAP and fail. Price can break the overnight high and still fail. The break is only information. Confirmation comes from what price does after the break. Does it accept? Does it hold? Does volume follow? Does price retest and continue? Or does price immediately rotate back inside the prior range? That difference is everything. For an evaluation trader, this is not just technical. It is protective. Because false breaks are one of the easiest ways to trigger emotional trading. You buy the breakout. It fails. You get stopped out. Then you short the failure. It bounces. Now you are angry. Now you are trading the last trade instead of the next auction. Auction confirmation prevents this. It forces you to slow down. It says, I do not need the first move. I need the confirmed move. That is institutional. Retail traders chase price. Professional traders wait for acceptance. Criteria 3, predefined invalidation. Before you enter, you must know exactly where the trade is wrong. Not where you are uncomfortable, not where you hope it bounces, not where your daily drawdown starts to hurt. Where the auction thesis is invalidated. If you are buying acceptance above VAH, the trade is wrong if price fails back inside value and cannot reclaim. If you are shorting rejection from VWAP, the trade is wrong if price accepts above VWAP and begins building value higher. If you are fading a failed breakout, the trade is wrong if the breakout level gets reclaimed and held. This turns drawdown from emotional pain into mechanical information. And that is exactly what a prop firm evaluation requires. Because the danger is not one losing trade, the danger is a losing trade that becomes a losing sequence. A losing sequence begins when invalidation is unclear. If you do not know where the trade is wrong, you will use hope instead. And if you use hope, you will hold on too long. If you hold too long, the drawdown becomes emotional. And once the drawdown becomes emotional, the evaluation is usually over at that point. So the institutional approach is not about being smarter. It is about narrowing your permissions. You are allowed to trade only when 3 conditions are present. 1, structural location. 2, auction confirmation. 3. Predefined invalidation. No location, no trade. No confirmation, no trade. No invalidation, no trade. That's the framework. The day-by-day evaluation protocol. Now let's turn this into an actual evaluation protocol. Assume you are doing a 10-day evaluation. The mistake most traders make is that they treat every day as a chance to push the account toward the profit target. Yes, that sounds logical, but it is psychologically dangerous because it makes every session feel like a quota. Auction logic does the opposite. It says every day has only one job. Execute correctly when the market gives confirmation. That is it. Days 1 to 3. Profile only trading. For the first 3 days, your job is not to make big money. Your job is to prove that you can obey the auction. Profile only trading means you are not allowed to take any trades unless it meets all 3 auction criteria. The market must be at a meaningful level, there must be acceptance or rejection, and the invalidation must be clear before entry. If that means 1 trade, fine. If that means 0 trades, equally fine. If that means a small green day, okay. If that means a small red day, so be it. The goal of days 1 through 3 is to establish behavioral control. Because the worst thing that can happen early in an evaluation is not a small loss. The worst thing that can happen is an early oversized win that teaches your brain the wrong lesson. An oversized early win can become poison because now the brain says, that worked, do it again. And that is how traders begin increasing size before they have earned the right to increase complexity. So days 1 through 3 are boring on purpose. You do not try to pass. You are trying to become difficult to eliminate. Days 4 through 6. Build conviction in the structure. Days 4 through 6, you should have enough information to start seeing how the specific contract is responding to auction levels. ES and NQ do not always behave the same. NQ may overshoot levels more aggressively. ES may respect value edges more cleanly. A market in a news-heavy week may behave differently than a market in a balanced rotational week. So days 4 through 6 are about building conviction in what is actually working. Track which levels produced information. Did VAH rejection work? Did VAL rejection fail? Did VWAP act as a magnet or as a launch point? Did POC become chop? Did prior highs lead to initiative continuation, or did they become traps? This is where the trader becomes more institutional, because institutions do not ask, did I win? They ask, what type of auction environment are we in? Are we balancing? Are we trending? Are we accepting higher? Are we rejecting lower? Are responsive participants in control? Are initiative participants in control? That context determines which trades are appropriate. If the market is in balance, you fade the extremes. If the market is accepting outside value, you do not fade too early. If price is building value higher, you stop shorting just because price looks extended. If price keeps failing above VAH, you stop buying breakouts without acceptance. This is how you adapt without becoming emotional. Days 7 through 8, the danger zone. Days 7 and 8 are where evaluations are often lost. Not because the trader suddenly becomes bad, but because the trader has enough progress to feel close. After a few green days, the brain's reward circuitry increases risk tolerance. This is the exact moment where traders say, I can start to press a little. I have a cushion. I can pass today. I will just take one bigger trade. That is the setup for failure. So the rule for days 7 and 8 are simple. Position size stays fixed regardless of your P&L. The auction does not reward streaks. The market does not care that you are close to passing. And the evaluation does not give you bonus points for feeling confident. Your size is not allowed to increase because your emotions improved. Your size can only increase if the plan allowed for it before the evaluation began. This is where discipline becomes mechanical. Same levels, same confirmation, same invalidation. same size, and same process. Because the moment you change the process because of your account balance, you are no longer trading the auction. You are trading your evaluation status. That is a psychological reason, and psychological reasons do not pass evaluations. Days 9 through 10. Execute the same process. Days 9 and 10 should feel almost boring. If you have done this correctly, you are not desperately trying to pass. You are executing the same criteria you used on day 1, and that is the point. The evaluation passes because the process held, not because you forced it. This is why the institutional approach is so different from the retail approach. The retail trader asks, how do I hit the target? The institutional trader asks, how do I survive long enough for edge to express itself? Those are not the same question. In futures trading, avoiding bad trades is often the edge, especially for prop firm traders where drawdown control matters more than catching every move. That sentence should be written at the top of your evaluation plan, because most traders do not fail from missing one good trade. They fail from taking 5 bad ones. They fail from trading in the mid-range. They fail from sizing up after a green day. They fail from revenge trading after one loss. They fail from needing the market to give them something on their timeline. Auction theory removes that need. It says, the market either confirms or I do nothing. And doing nothing is not a weakness. Doing nothing is a drawdown protection. The one question framework. Now here's the one question framework. Before every trade in an evaluation, ask, is the auction confirming this location? Or am I entering because I need a trade? That's it. That question separates institutional execution from evaluation anxiety. Because if the answer is, I need a trade, that is not a market reason. That is a psychological reason. And psychological reasons do not pass evaluations. Let's walk through 3 scenarios. Scenario A, ES at value area high. ES opens inside the prior day's value. For the first hour, price rotates cleanly between POC and VAH. You may mark VAH before the session. You know this is a meaningful location because it represents the upper edge of accepted value from the prior session. Price pushes into VAH. Now the inexperienced trader sees price rising and buys the breakout immediately. But the auction trader waits. Price pushes a few ticks above VAH, then sellers respond. The breakout fails. Price rotates back below VAH. The next candle cannot reclaim it. Volume increases on the move back inside value. Now you have a responsive selling confirmed at a meaningful auction level. That is an auction reason. The trade idea is short back toward POC. The invalidation is clear. If price reclaims VAH and accepts above it, the rejection thesis is wrong. That is a valid evaluation trade. Not because it is guaranteed to win, but because it has location, confirmation, and invalidation. That is all you can control. Scenario B, NQ mid-range with no level. Now imagine NQ has been chopping for 2 hours. You have not taken a single trade. You are watching other traders post profits. You are thinking, I cannot just sit here all day. Price is in the middle of the prior value area. It is above VAL, below VAH, near neither extreme, not clearly accepting above VWAP, not rejecting from POC, not at prior high, not at prior low. There is no meaningful auction location, but then a large green candle appears. You feel the urge to buy. Why? Well, not because the auction confirmed, but because you need a trade. That is the trade that destroys evaluations. It does not look dangerous in the moment. It feels reasonable. It feels like participation. It feels like you are finally going to do something, but structurally it is weak. You are entering mid-range with no clear location, no clean invalidation, and no auction reason. That is a psychological trade. And in an evaluation, psychological trades are expensive, even when they win. Because if a bad trade wins, it trains you to repeat bad behavior. That is one of the most dangerous outcomes in trading. A bad win is sometimes worse than a clean loss. Because the clean loss reinforces discipline, the bad win reinforces impulse. Scenario C, price approaching POC with initiative buying. Now imagine ES is opening below prior value. Early in the session, buyers step in aggressively. Price starts moving toward the prior day's POC. The inexperienced trader says, "This looks strong. I'm buying before he gets there." But the auction trader understands that POC is not just a line. POC represents the fairest price from the prior auction. It can act like a magnet, but it can also act like resistance or a decision point. So instead of buying directly into POC, you wait. Price reaches POC. Now you ask, does it accept or reject? If price hits POC and immediately fails, that is not a long. If price hits POC, pauses, holds above it, retests, and begins building acceptance, then you have confirmation. Now the trade becomes continuation towards VAH or the next structural level. The entry comes after acceptance, never before. This is the institutional difference. Retail traders predict the auction. Professional traders let the auction reveal itself. And that matters even more in an evaluation because every early entry increases emotional pressure. If you enter before confirmation, you are now hoping confirmation appears. That is backwards. You do not enter and then look for confirmation. You wait for confirmation and then enter. This one change can dramatically reduce the number of emotional trades you take during an evaluation. So the question remains, is the auction confirming this location, or am I entering because I need a trade? Ask that before placing every trade, because the answer will expose the reason behind the trade. Okay, how all three work together in a real trade. Now let's put all three parts together in a real trade sequence. Assume NQ opens above the prior day's value area. That tells us something already. The market is not opening in balance. It is opening outside of prior value. So now the question is, will price continue accepting higher, or will it fail back into value? That is the auction. Not bullish, not bearish, just a question. The first move pushes higher after the open. Retail traders chase, but you wait. Price pulls back toward prior VAH. This is now the key location. Prior VAH is the boundary between acceptance above value and failure back into value. At that level, buyers step in. Price holds above VAH. It retests. It cannot get back inside value. Then it starts pushing higher again. Now you have all three criteria. Structural location, prior VAH. Auction confirmation, acceptance above value and failed attempt to rotate back inside. A predefined invalidation. If price loses VAH and accepts back inside value, the long thesis is wrong. That is an institutional evaluation trade. Your risk is defined. Your reason is structural. Your entry is confirmed. Your stop is not emotional. And your target can be based on the next auction reference point, the overnight high, prior high, measured range extension, or another volume-based level. Now contrast that with the trader who simply buys the first candle because NQ looks strong. Same direction, completely different trade. One is auction-based, one is emotion-based. And this is where traders misunderstand prop firm evaluations. The evaluation is not only about whether the trade wins, it is about whether the trade can be repeated without emotional damage. A random long that wins creates overconfidence. A structured long that wins creates trust in the process. A random long that loses creates frustration. A structured long that loses creates information. That is the difference. Auction theory does not guarantee that you will pass. Nothing does. But it gives you the exact behavioral structure that evaluations are designed to reward. Patience, selectivity, defined risk, consistency, drawdown control, and the ability to not trade when the market gives you nothing. The last one is the hardest, and it is often the edge. Now let's talk about which prop firms reward this approach, because this is where the connection becomes obvious. Apex Trader Funding, Topstep, FTMO, different firms, different rules, different account structures, but the underlying principle is all the same. They are not just evaluating profit, they are evaluating risk behavior. Apex Trader Funding has account structures where drawdown control, trailing thresholds, Daily loss limit language and rule compliance matter depending on the account type. The important point for an auction trader is that you cannot treat the account like unlimited emotional capital. The structure forces you to protect downside first. That favors disciplined structural trading, not chasing, not revenge trading, not pressing because you feel close. Topstep is even more direct. Topstep's trading combine includes a consistency target, where your best day cannot dominate the overall profit target beyond the stated threshold. This is exactly the kind of rule that punishes lucky oversized days and rewards repeatable process. Auction trading fits that because it does not depend on one heroic trade. It depends on taking confirmed trades repeatedly from meaningful locations. FTMO is built around a maximum daily loss and maximum loss constraints. The account equity cannot breach those limits, including open position impact in the daily loss calculation. That is exactly the environment where predefined invalidation matters. Because if you do not know where the trade is wrong before you enter, you are exposing yourself to the exact type of behavioral drift these rules are designed to catch. Every evaluation rule at these firms are designed to reward exactly what the auction teaches. That is not a coincidence. The institutional world has always evaluated traders on drawdown discipline. The auction is how professional traders build that discipline. Because professional trading is not about finding excitement. It is about controlling exposure. It is about knowing when the market has created opportunity and when the market is simply moving. It is about understanding that not every candle is an invitation. Not every breakout is acceptance. Not every pullback is value. Not every loss needs to be recovered immediately, and not every day needs to produce a trade. That is why auction market theory is so powerful for evaluations. It converts the evaluation from a psychological test into a structural process. The trader no longer wakes up asking, how much do I need to make today? They wake up asking, where is value? Where are the extremes? Where is acceptance? Where is rejection? Where am I wrong? That is the institutional mindset. So if you're trying to pass a prop from evaluation, stop thinking the goal is to trade better under pressure. That is the wrong goal. The goal is to remove as many pressure-based decisions as possible. Auction market theory does that by giving you a process. First, structural location. Second, auction confirmation. Third, predefined invalidation. Then the one question before every trade. Is the auction confirming this location? Or am I entering because I need a trade? If you ask that question honestly, you will eliminate a large percentage of the trades that usually destroy evaluations. The board trades, the revenge trades, the catch-up trades, the overconfident trades, the mid-range trades. The trades where you are not really reading the market, you are trying to manage how the evaluation makes you feel, and that is the shift. You do not pass because you become fearless. You pass because your process gives fear fewer decisions to make. The full framework, auction criteria, pre-trade checklist, and evaluation protocol is laid out in my book, Trading on the Edge, available on Amazon. And remember this, the evaluation is not asking whether you can catch every move. It is asking whether you can protect capital long enough for your edge to matter. That is what the auction teaches. And if you're interested in learning more about the auction market theory, check out my video, Auction Market Theory Explained, what retail traders get completely wrong. All right, well, thanks for watching. Please make sure you like, comment, and subscribe. And I will see you in the next one.